All right, we're going to do exercise 11.6, which you do have a solution to in your study guide, but I thought it would be useful to annotate it and walk through one of these. It's a fairly typical one. So what we have is a scenario where we have an acquisition of control where Holdco acquires, watch this, I've been working on this technology for a while. Holdco is going to acquire 100% of the shares, see them moving over. There you go, from Mr. Lofty. Actually, the question doesn't tell us who he acquires them from, but we do know that Holdco acquires 100% of the shares of Lofty. And Lofty is, just to be clear, this is our taxpayer. This is the company for which we are, doing the tax returns and everything else. And so what this triggers then is a deemed year end. And so what I've got down here, so this the scenario given is the shares were sold on March the 10th. We know now that this triggers a deemed year end on the day before that. And so what I've got down here kind of pre-populated is my notes from reading the question. So before going forward, I'd recommend that you stop and read the question yourself and make these notes, or make similar notes, not these notes, but make your notes, and then kind of make sure that they match somewhat. Because, so there you go, pause, now we're back. And I know most of you didn't pause. But anyway, so we have basically 1, 2, 3, and then 4 things that we want to look for in these acquisition of control questions. And so when I look at these, I say, okay, loss carry forwards, why do I want to look at that? Well, because we know that those are going to expire, at least the net cap. So we're going to put a little star and say, okay, these ones are subject to expiry on an acquisition of control. These ones not, but they will be restricted. So the non-capital losses will be restricted going forward, but they'll survive. And then what we want to look for is we want to look at the accrued losses and or gains on all of the assets that they tell us about. So in this case, they tell us about a Class 8 asset that has we look at this is a $30,000 loss. Okay, I look at the inventory and I say, okay, its fair market value is higher than its cost. That's about right. So there's no loss. There's actually an inherent gain, but we know we can't take gains on inventory until we actually sell it. And then accounts receivable, what does this have? This has a $15,000 loss, saying basically when we looked at these account by account, we saw that there were $15,000 that we thought weren't collectible, that we read before this time, that are on the books as being collectible, $15,000 in respect of not to be collected. Then we have this customer list, which is eligible capital property. And so first thing we look at, we go, okay, well, it seems to have a gain on it. But in order for us to calculate what that gain is, we remind ourselves, wait a minute, I know that these are not whole dollars, right? The fair market value of this thing, if I were to sell it, if it were deemed to be disposed, the amount leaving the pool would not be 68. It would be 3/4, it would be 51. Which says to me then that I do have an accrued gain on this thing. So I'm going to put it in green. Accrued gain of $1,000 of eligible capital property. Then when I look at the land, this one they told us specifically does have a gain of $56,000. And then this last piece over here is just telling us for this year, for this is the tax year that we will be filing a return for now, January 1 to March 9th. Already there's been loss for tax purposes of $3,000. Okay, and then the other piece of information they give us is that there are plans to be profitable. And what that tells us is that really these non-capital losses, so both this and the amount carried forward, have value, right? So let's just put, therefore, the losses, if we're right, have value. Because if we're not planning to carry it on and it's not expected to be profitable, then these losses have no value, and so there's no reason to preserve them. But what question part A tells us then is to say take the maximum election. And what that means is you deemed disposition of all assets with gains, with accrued gains, at their fair market value. Okay, and so I think there is actually a flaw or an error in the question. The question says, all the question says is if the maximum election is taken. Well, if the maximum election is taken, then we have two things here, right? We have this customer list. Well, let's just, because it's a pool, the eligible capital property, and then we have land. But I don't think you would, and so to be clear, you get to elect these things on an asset-by-asset basis. And I don't think anybody would want to elect, especially knowing that they want to be profitable and have these losses going forward, nobody would want to elect on that eligible capital property because we can see that it has recapture that would come with it. And so I think the question might have been meant to have said if the maximum election is taken on the land. Okay, so that's the solution that I'm going to prepare as if, and that's consistent with the solution that they have in your study guide. All right, so if we're electing on the land only, then and the election will come later, actually. So what we first need to do is figure out what is our loss for the year. Okay, because we know we have this. So the loss for we'll call it the deemed year end, or the short year, whatever you want to call it. We have this business loss that we have already incurred in the short time that we've been that the year has been on, January 1 to March 9. Then we have these ones that have arisen because of these deemed disposals. So we have $30,000, and then we have the write down of the accounts receivable. Okay, so this gets us to a $48,000 loss. Okay, so let's look at what is our Division B income for the year. Well, we have income of 0. We have a taxable capital gain. Now this is as a result of the election. Okay, there is no real taxable capital gain, but we have a taxable capital gain of $28,000, which is 56 the gain times a half. This is the election, right? So we chose this. We said we're going to elect at the maximum amount, fair market value, and that gives rise to that gain. So our 3C income is $28,000. But then we take off these non-capital losses that we have. So which are, we just calculated, $48,000. So our Division B income is 0. Okay, so it's negative, but its Division B income is capped at 0, so it's 0. So then we say to ourselves, okay, and what is our taxable income? Well, taxable income is 0 as well. So if you recall, in a loss year, the way that we actually calculate the losses, the non-capital losses that we have are this way. So the loss of and we'll call this the short year again. So let's just call it the step 3 loss for the let's do non-capital loss. Okay, as you recall, we did this in an exercise before when we had those 4 years. I think it was problem 11.1. So non-capital loss we know starts with our business losses. We have no property losses, so we have business losses. We know that that's $48,000. Okay, and we're using these as a plus. Then we add these net capital losses deducted. Okay, so what do we end up deducting? Well, this is the point here. The whole point of making this election is that we have these, I'll do it in green here, we have $30,000 of net capital loss carried forward. Okay, but we don't really have $30,000, do we? We have 30 that arose, so we need to multiply that by a half and divide it by 3/4 to get to 20. So what we really have are $20,000 of net capital losses carried forward. And we have gains this year of 28, and so we can deduct the whole amount of 20. So by making this election, we chose to do this. And you'll recall that what this does is this increases the loss that we have. So then we take away this 3C income that we have, and that is 28. And that tells us, okay, so my loss for the year is 40. So really what we've done is we've said, okay, if we had not made this election, we'd have $48,000 of non-capital loss to be added to the pool. Now we have 40. So the consequences of this, so really the question is asking for the consequences. We have the non-capital loss, loss carry forward. So this is now going into, so let's call this as of March 10. So the beginning of the next year will be, so this is 2011, so the new tax year. Those will be, we have $600,000 that arose in 2010 that will expire, well, 20 years from that, but we've now, the deemed year end counts as one, so assuming that they keep a December 31 year end, then I think those will expire in 2029. And then this $40,000 that arises in our 2011, put a star 2011 short year, that's when they arose, then they will expire a year later, I think. And then what we have is we have the ACB of the land. This is another consequence of taking the election. It's $56,000 higher, right? So this is 56K up from 200K that we started at. So basically, if we were to sell that land tomorrow or March 11th, then we have $56,000 of gain that we would not pay tax on. So $28,000 we've saved, $28,000 of income we've kept from being taxed by making this election. Okay, and then these things we have nothing. There's nothing we can do about it. We just need to note that the UCC of Class 8 now is 40 because it was written down, as well as the accounts receivable balance is 225. And again, they're not elective. These are just, that's what it is. But there could be income implications to this, right? Because the 40,000 tells us that we just don't have as much to flow to UCC in the future years. And the accounts receivable says, well, it's possible that if we collect more than we thought we were going to, we will have income. We'll have income and therefore tax to pay. Anyway, these are not anything we can do about. So what we'll look at next in Part B is what happens if we don't elect the maximum amount, because it kind of looks like we wasted about $8,000 of gain here, or loss, as it were. We have $20,000 here that we deducted, but in order to elect it, when we elected fair market value, we had to elect 28. And so it seems like there was an 8 there that we might not have needed to sacrifice. So we'll look at that in Part B next. Okay, Part B, really what the question is asking is for something kind of specific. It says determine the minimum amount. The minimum amount to elect. Okay. The solution in the manual or in the study guide goes further and walks through everything else. So, but I'll probably leave that to you. What we're doing here is what we're saying as an alternative to the maximum, okay, and which the maximum is fair market value. Okay, but they kind of change things up on us. So please note, I don't know why they do this, but it's I don't know why. So they change two things. One, the fair market value of the land is now $300,000. Okay, it used to be $256 in Part A. Remember that? They've changed it now to $300,000. Okay, so that's an important change. And then they've introduced a property loss of $10,000. Okay, so we can't really, what I wanted to do is I wanted to go back and just alter the numbers in part A, but I think that would be more confusing than helpful. So instead what we'll do is we'll just do this one and answer the question that is asked. The question that is asked is, what is this minimum amount? Because their implication is it is not $300,000, okay? Because that's the maximum amount. So what will the amount be? And we're given this rule of thumb that says, okay, well, really what you want to do is you want to use up everything that's going to expire, and then you want to cover the ACB of the property being elected on, which in our case will be the land. So the way this works is we have, so we'll just say proceeds should be equal to 2 times, and again, this is 1 over the inclusion rate. But for now, that is a half. Sorry about the writing. So 1 over the inclusion rate 2 is multiply that by the capital losses that are going to expire. And so our case, this is the 30 that's being converted, right? 30 converted. And then we have introduced this we've introduced this, come on, blue pen. We've introduced this $10,000 property loss. Okay, so those are the two things that are going to expire. I won't bother scrolling back up, but you have to take my word for it. And so when we look at this and we say, okay, what, why are those the amounts? Well, that's basically we want to recognize as much gain as we need to cover those things. Plus, of course, because what we're doing is we're calculating proceeds. So really what this is the gain, and then what we need to add is the ACB. I won't write the caption. We'll instead just write $200,000, which is the ACB of the land. Okay, ACB of land. So the reason, so hopefully you can see that basically that the proceeds are divided into two things. We would just want to cover the cost, and then we want to cover we want to add enough gain to pick up what is being lost, or which will expire. Okay, so really our answer to this question then is 2 times 30, 60, $260,000. Okay. And for the rest of it flows through exactly the same way as before. So I will leave this to you for you to see. So I'll just say see the rest of the solution in the study guide, because it's straightforward and repetitive of what we did before. So I was about to finish it off, and then I thought, you know what? Why don't we look at part B as if they didn't make those changes, which I don't know why they made the changes. I think they just maybe thought it was a little bit too straightforward. But let's just look at it B with no changes. Because really what we want to understand is, did they need to give up that $8,000? Right? They had this $28,000 capital gain that they had to recognize in the year when they elected at the fair market value. But did they have to do that? So let's just look at this and say, okay, so let me calculate my proceeds now. So this is kind of the optimal proceeds to preserve the non-capital losses that will be carried forward. Because you recall, they lost, I'll just scroll back up here to part A that we had. This 40 here could have been 48. So let's see what we can do about that. So we come back here down to proceeds, and we just would have a very simple 2 times what's going to expire, and that's just the net capital that we had to convert, if you recall. That's it, plus the ACB of the land. So that means we would elect our proceeds at $240,000. So if we elect our proceeds at $240,000, that means our capital gain is $40,000. Our taxable capital gain is $20,000. Okay, so hopefully you can already see, well, wait a minute, that's going to perfectly offset the expiring loss. And so when we go back up here, let me just, don't know if it's going to be better to scroll or to do it again. Let's do it this way and see how you feel about it. So we'll do it all in green, which I think is okay. We haven't used, we've used all the colors here. That's a pain. But anyway, let's use green and just go, okay, so what will we do here? Net taxable capital gain, we just figured out would be 20. Okay, so going back, that's 20. That makes this also 20. The non-capital losses had stayed the same, and so we had just had an in and 20. So it's still 0. Business loss is 0. Loss deducted 20 division. So this changes, and voila, we have done exactly what we thought we could do. We could save those $8,000 going forward. Okay, so that's really the point of Part B, is that. So again, I don't know why they made that change, but just so you can understand, that's really what the difference is. If you think that those $8,000 of non-capital losses carried forward are valuable to you, then you want to elect an amount that will preserve them, and that's what we've done here.